All right, great. Well, welcome everyone. Quick background on James Patrick, our guest for today. He's a filmmaker and economist of the Austrian School. I know James to be passionate about uncovering uncomfortable truth, let's say, and he's very comfortable exposing everything that he sees. He studied under David Webb and other banksters recently the issues that were raised in The Great Taking, the book that David Webb published. And that's the main theme of his most recent publication called The Great Taking Report. He's going to talk more about that soon. Probably worth noting that he's also doing a PhD thesis under Jesus Huerta de Soto, which is the guy who influenced Milei and I think coordinated Milei's thesis, if I'm not mistaken, James, right?
Milei didn't have he was an economics professor for some years, but he didn't like formally study under De Soto. He was like a economics professor for over 10 years but teaching mainstream economics, and then heard about De Soto's stuff and totally changed his worldview. So he really credits him as his mentor,
Okay. All right, well, let's go into the meat of the topic. You recently started this publication that you call The Great Taking Report. And I know that the main purpose of it is to dig deeper into what David writes in the book for people that really want to understand the mechanics behind how this great taking is possible. So, tell us more about what are you talking about in this publication? What are you covering? Who is this for?
Okay. Yeah, basically, I have a long interest in economics and really went into the school for 20 years now. And there's always been a big disconnect between economists are usually just academic wonks and pretty useless, and then really people in the markets and in business. So there's really not enough Austrians really looking at the real markets and what's going on. So I've been kind of advised by David and a number of other bankers on going through what's going on in the markets today and critiquing them with an Austrian perspective. So really sort of the biggest. So I guess a little background. I did this film on the COVID issue, playing a lockdown, and then a piece in the Dutch farmers. But really, then last December came out with a film on the central bank digital currency. So a lot of my research now is focused on the tokenization of all assets, the Bitcoin, the origins of Bitcoin, how they really laid the groundwork for CBDCs, and how really we're moving towards a more the direction that the financial system is moving is really kind of digital IDs, bringing in CBDCs, tokenizing all assets, not just securities, but all EU's recently called for an asset registry recently. This just raises a lot of concerns because usually governments don't want to register your assets unless they want to tax them or take some of them away. So it's not a good direction things are moving in. And so this is kind of as a civil rights issue I was doing this. So I came out with this film last December on CBDCs, which Maverick I showed a draft at the Turkish conference last year. And then, but really I think the biggest financial story now is this issue of that all securities, all stocks and bonds have really for many, many decades now, really I think since the 60s in a big way, but in the 70s, it got basically everyone's broker and their custodian, your financial service providers have been really playing with your stocks and bonds without telling the client and encumbering them, lending them out to other firms to use as collateral or using them on their own bets. And this sort of started as a fraudulent activity. I think it is still fraudulent, but it was basically this was then it's like fractional reserve banking where you deposit your money in the bank, and the banks started to loan it out. Like in the medieval times, the goldsmiths started to use their clients' deposits for their own gain and try to get away with it. The clients weren't all the wiser. Basically, the same things gone on in the late 20th century and with the securities. And this really presents a lot of problems where they're legally encumbering the securities. They're keeping them in pooled accounts. Brokers, custodians, and financial intermediaries that they're lent out to are encumbering the stocks and bonds. And so there was a progression there was this sort of lobbying effort. This one issue was it gets a little crazy when you're lending out a security as a broker, so another firm's taking it, and then they're lending it again on another bet, and then it can happen again and again, and it gets hard to see from a big macro perspective how much leverage is actually going on in the market. So in the early 70s, really 1967, there was the Belgian constitution was changed to allow create these provisions allowing for this use of client securities. And then in 1968, JP Morgan Chase of New York created Euroclear in Belgium. So you can see there was this initiative started back then to create these central securities depositories to keep all the securities in not just down in the little broker level and all these different firms playing with them, but keep them in these massive central securities depositories so there could be a higher level view on how much leverage is actually going on in the market to manage this free use of the client collateral, because it just get really out of hand. So then in 1968, they claimed there was this paperwork crisis in New York, that this was getting so unmanageable, having to have all the clients, when you give your stock over to your broker, you have to sign it over to the broker and then he trades it. So they said, oh, well, why don't we dematerialize all the securities and keep them in the Central Securities Depository in New York. And so there was a call in 1968, they claimed there was this paperwork crisis and in New York. And so 5 years later, they created Deposit Trust Clearing Corporation in New York City. So when you read the official history, they'll say, oh, because of the paperwork crisis, we had to create DTCC. But it was like a full 5 years later. And, while it may be a burden of paperwork to have everyone signing off all these paper certificates, there certainly could have been a better way to preserve people's property rights and not have it compromised. It really looks like there was this industry practice going on of using this client securities that was happening so much. There was a lobbying effort to push the market towards greater dematerialization of the securities and having them kept in these central securities depositories to facilitate a more efficient use of the client's securities as collateral. So then if you go a little further, bankers in the industry told me by the 80s, the use of the client securities got really attenuated in the 80s. And then there was some crises in the 80s that there started to be more policy talks about modifying the laws around securities. And really the big, huge foundational legal change happened in 1994 in the United States with the Article 8, 1994 revision of Article 8 of the Uniform Commercial Code. So this was passed in all the 50 states, most of them between 1994 and 1996, but some didn't get passed until 2000. But really this created two novel legal terms. One was called they basically substituted the direct ownership of a security with a contractual claim on a security, so called a securities entitlement. I'll pull up some things here. But so basically, the way you should look at this is that they wanted to conform the laws to industry practice. So there was this kind of fraudulent practice going on. They had to create all these legal constructions to conform the law to industry. So what you basically saw over several decades is like a progressive legal changes that undermine clients' rights to the benefit of the industry. Were you going to ask something? Or?
I wanted to break this down a little bit from from what I've read in your first part of the report, which directly focuses on
Okay.
these central security depositories, clearinghouses, otherwise known. So what I understand that after the 60s, when these clearinghouses showed up, they acted as a sort of pools of collaterals from all the securities that have been bought by the clients. And if I understand this correctly, before the 60s, if I had bought security in, say, Peabody Corporation or Exxon or whatever it was, I would have gotten a title that says I own this many stocks in this company, and I would have a certificate of ownership to the stocks of that company, right? However, when after this paperwork crisis that was used in order to digitize these certificates of ownership, these clearinghouses showed up in the picture. So the state today, I'm breaking this down in a very basic way, but this is the way I think we should see it, is now as an investor, instead of owning a direct ownership title to a stock company, what I do is I use a broker who instead uses a clearinghouse that owns the pool of those securities. And not only that, but has the legal right to encumber them, to collateralize them for the financial institutions that that use leverage to justify the derivative contracts. So I think my question here, or where I have doubt in understanding how this works is, when did these custodians got the legal right that they encumber my asset for somebody else's leverage? I mean, how come they are legally allowed to do that?
It was sort of an industry practice that's still not really admitted fully to clients. So, and the big real legal, I would say the big real legal authorization occurred with this 1994 revision of Article 8, where they said your direct legal ownership is substituted with a contractual claim, and so now you have a claim against your broker for your security that you bought. You bought 100 Apple stocks. You have a contractual claim to Apple stocks against your broker. Now, he's got to legally honor them, and the way that this code was written, I mean, I can pull it up here. You can see it because it's a little sneaky the way it was written. It'll say like securities entitlement holder has priority, except all the time when the secured creditors have priority ahead of the entitlement holder. So it's a little the way that this code was written is a little two-faced. It says you have property rights except all the time when you don't. So you really have to read the code several lines deep. And when so we went to these hearings in 2004 to amend Article 8 of the UCC to strike some of these exceptions, because it'll say entitlement holder has priority. The two big legal things here was they invented this construct of the securities entitlement holder. The second thing was they said the secured creditors of the derivatives contracts the financial intermediaries that are playing with your stocks and bonds. Each derivatives contract, like these securities, will get usually swapped for a U.S. Treasury bond. The U.S. Treasury is usually the required collateral. Cash or a U.S. Treasury would be the required collateral for a derivatives trade. So they'll take your stocks and swap them for a U.S. Treasury, and then post the U.S. Treasury as the collateral, and then that'll get taken again and again and again. So when it's put as an initial margin on this derivatives contract, then the secured creditor of that contract will then get control of the security, and then will go and play with it again on another, post it as collateral or rent it out to another firm. So that happens many times over. So I'm trying to share the screen because I can show you. Is it sharing anything?
No, we cannot. We would have seen before, yeah. You have a quadrant
Okay.
below the public chat, and if you expand that, you can see the whole screen.
Okay. So yeah, the key thing is really the change in the UCC code, and then this changes in bankruptcy law, and then the changes in bankruptcy law happened just before the Lehman collapse, and then after the Lehman collapse, the regulators said, "Oh well, this was so there was all these financial products going on. This was so bad. We want to regulate the derivatives industry more and have them all cleared through these entities called central clearing counterparties." So now when you sign up and you make a derivatives contract, they're channeled all through these central clearing counterparties, these entities that are kind of above the DTCC. And the issue with this is that it does make the trading a bit more efficient, but at the expense of creating a monolithic risk of channeling all the derivatives market through these central clearing counterparties, which really aren't well funded.
What's the
so
difference?
In the event of
what's the difference between the pool of collateral and the immensity of the financial market that is trading against, over leveraged against that collateral? Do you have any rough idea?
Well, they're just a clearing entity that'll facilitate the clearing of the derivatives contracts that are utilizing the client collateral. So really, these changes in law in '94, we really saw that by the time they were fully implemented around the U.S., we saw the derivatives market really start to explode exponentially. So by 2001, it was $100 trillion of global derivatives. By 2007, it was $700 trillion. They say now it could be around 2 quadrillion, but it's hard to know exactly.
Wow.
Another big thing that was going on was this increasing use of also JP Morgan Chase created the development of the repo market. So this repurchase agreement market is now the primary interbank money market activity. These contracts that are the repo market contracts, repo contracts are basically the same thing as these margin loans that were going on in the 20s that then really led to the 29 crash. And then in the early 30s, there was a lot of regulations around like Glass-Steagall and things. They really declared these contracts closer to gambling, and they sort of banned them and tried to separate the banks using these margin loans so recklessly. So the issue is that when you're putting down as collateral on all these contracts initial margin, then there's this flurry of bets surrounding them.
James,
when the market starts to go down, there's just these massive collateral calls and this massive selling of the contracts and selling of the collateral. There's calls for more collateral if the prices go down or the value of the collateral drops. You have two things going on. You got the value of what you're speculating on changing, and then you have the value of the collateral you posted on the contract changing. If there's downturns in the market, the people hosting the contracts demand more collateral. If you can't pay any more collateral, they take the collateral and they sell it immediately. So when you have these price drops in the market of a market consisting of these kind of contracts, you have an inherent systemic instability of a tendency to cause a collapse. So these margin contracts caused this 1929 crash basically, because there was these massive calls. The bank started calling in all the contracts, and then the market collapsed. So now we have this repo market has really gotten, since the mid 90s. Now it's the dominant money market activity. It's the very same contracts that were going back on at that time. It's very risky now what's going on. There's a lot of there's some economists talking about it. I mean, I've been reading about this all day, recently. Mm-hmm. But there's basically, this really should be wound down or regulated in a way to stop this, because it's inherently unstable. The Bank of International Settlements has written a lot of reports about the risk of what they call margin spirals. So once there's some sales in the market, then you get these kind of death spirals where the whole market can just start to collapse. So that's what David is alluding to in his book about the risk of the derivatives market fueled by repurchase agreement contracts and having this built-in inherent instability and tendency to susceptible to these sort of massive collapse when you get these collateral calls. I don't know, does that make sense?
That makes sense. I think what's difficult to grasp is the actual implications, the final implications of what this collapse could mean and for what type of people. And I wanted to ask, when we say securities, do you mean just stocks and bonds, or what exactly does these securities that are part of the DTC that are collateralized and basically at risk of being lost by their rightful owners include?
Well, I mean, so most of these contracts the collateral requirement is U.S. Treasury bonds. So, but there are a number of BIS documents saying that, well, there's not going to be enough collateral because there's so many contracts with using rehypothecated Treasury bonds. I can show you a Bank of International Settlements. So basically, Bank of International Settlements has the best. It's really the only source of derivatives data. Let me see if I could pull up this screen share thing again. Okay, am I sharing it now? Yeah.
It's still frozen.
Can you
You
see
need to stop sharing and then reshare, I think.
And share it again? Okay. Okay. Let me see. We're now sharing a screen. Share. Okay. So in the September 2023 quarterly report, the Bank of International Settlements gave a little chart of the 5 and 10-year Treasury bonds and the levels of leverage. And between January 2018 and January 2022, the amount of leverage on U.S. Treasury bonds is like 150 times leverage.
Wow.
So you're talking about levels of leverage that are pretty insane. Now, I think that the value of the Treasuries changed at that time, and so they dropped. Now it's this report was showing it now in the like 75 times leverage range after that. But there's these like I was saying, you can swap when you don't have U.S. Treasury bond, but you want to enter a derivatives contract that requires Treasuries. You do collateral transformation. You kind of swap your stocks for the Treasury bond and then post that as collateral. So now that everything's in these massive pooled depositories, if there's a massive collateral call, it can lead to this automatic sweeping of everyone's stocks and bonds, and transform them to Treasuries, and then go lose them for you. So that's discussed in these documents, and that's what's the concern here, is that now there's a legal structure in place that makes this legal. There's automated globally integrated collateral management systems, and Bank of International Settlements documents are talking about sweeping there's not going to be enough collateral in a massive margin spiral, and that there'll just be calls for more and more and more, because you can't back up $2 quadrillion of derivatives with only $130 trillion of securities. In DTCC, there's like $89 trillion of stocks and bonds, and in Euroclear, there's about 37 trillion of euros worth of stocks and bonds, but there's like a $2 quadrillion derivatives market, and that's the concern here, that there's never enough collateral to cover all these contracts when it's rehypothecated. In aggregate, it's probably rehypothecated 20 times, but if you just took these general numbers, but probably like 20 trillion of the stocks of the stocks and bonds are being used to back up 2 quadrillion.
Well, yeah, that's mind blowing. But my question remains: what do I stand to lose here in which circumstances? So presumably, based on what you're saying, if I own any type of stock with any type of broker, and it doesn't matter if it's in the US or the
you're at risk of loss to your financial intermediary, and that's the question you'd want to ask your broker, the lawyers, the banks handling your stuff. You'd say, am I at risk of loss at the bankruptcy of the financial intermediary? And they'll have to tell you yes.
And my second question is,
this information would just want you to get out of the markets and buy gold, basically. I mean, because it's inherently like you're at risk of holding any stock and bond if it's being played with. So anyway, so basically the focus of my report is breaking this issue down, and then it's the first 5 chapters are really breaking it down. I've written these first 2, and then the last 5 of these 10 chapters is really I'm analyzing all the world's markets and giving a briefing on the status of the use of the securities and the legal structures in place. So right now I'm in Indonesia. Here, the Indonesian securities are not integrated. You know, this is not going on, but there's talks now of bringing them into Euroclear, but Hong Kong and Singapore are fully integrated. You know, are mostly integrated. So I guess I mean but this is my task for the next 6 months is really talking to banks in around the world and getting into the laws of each jurisdiction, each region. I know I've seen a lot of stuff about Latin American stocks that are being swept up into DTCC in Euroclear. There's an IMF economist named Singh that writes a lot about it. But yeah, this is sort of like the issue here is how what risks are you exposed to? You know, a lot of the people you deal with won't even know this. I mean, they're not. You know, like David Webb ran a hedge fund for 20 years and had no idea that he closed it, and then he found out the year after he closed it that this was going on. So
yeah, and just to be clear, I think this applies to any type of assets that you have with your financial institution, presumably, right? So that includes perhaps cash in the bank, deposits, mortgages.
No, cash in the bank is a different thing. I mean, cash in the bank is wholly different thing. I mean, this is about stocks and bonds, so financial instruments. Cash in the bank would be regulated by. I mean, I think you have in the U.S. I mean, you have FDIC insurance per bank, $250,000, or I think what in Canada it's 100,000 or something. In the EU, it's I think 200 or something. But that's a wholly different animal, like cash in your bank. This is really stocks and bonds.
Right. Okay. Very interesting. Does anyone here have any specific question to James? So James, based on your research so far, it seems that Indonesia is the main market that somebody would have the courage to invest in without running the risk of loss.
No, I wouldn't say it's the main market. I mean, it's one market.
Nick, I see Nick has a question. Go ahead. You need to unmute yourself first, Nick.
Yeah, sorry, I've never been on this platform before, so I'm just trying to figure out how all the buttons work. James, thank you, and I'm sorry I've only been online for the last 10 minutes. I missed the first part of your talk.
Yeah, sorry, it's like 12:30 at night where I'm at, so excuse me from a little.
Okay, yeah, it's 6:30 here. 6:30 here in Cape Town, South Africa. So just by way of brief introduction, I'm a private equity investor, and part of the reason for being one is I became suspicious of intermediation at a very young age. So, and to me, intermediation is another way of referring to this kind of almost indefinite onward progression of one person's debt becoming another person's obligation, and liability and so on, and these long chains that go through rehypothecation or onward lending or onward investing. I saw how at every step of intermediation there was this extraction happening, frictional costs, and as the number of layers expanded, there was just what can only be called theft happening, because the actual value add by each person in the process was zero. And I first became aware of it in the life insurance industry. I'm an actuary by profession. And when you looked at the number of layers of fees in the products, it became statistically impossible for the ultimate asset manager to outperform the fees. So it was just a dead weight withdrawal in South Africa, reaching a level of 6% a year in reduction in yield for the original policyholder, which will flatten your retirement savings by the time you get to retirement. And so I just became very averse to investing in anything that involved any levels of intermediation, and I've ended up in private equity where you own the shares in a company, and that's that. Do you think that there's this is a very selfish question, do you think that there are means by which investors could be parted from shares in privately held businesses?
I mean, it would be if they're held through a broker or custodian or on a central securities depository. It's more if you're holding the company privately, you should be able to hold it straight up. No.
Yeah. No.
Unless there is a relation.
If it's a publicly, the issue would be if it's publicly traded, and then it's kept through these intermediaries. The issue, like you're saying, it's the issue is the intermediaries, and then you're exposed to the risk of the intermediaries and then the legal systems in place that put you at a disadvantage there. So I'm not aware of what's the system in South Africa, but it depends. I mean, in the U.S., if you have a physical share certificate of the company, then you have a clear title to the company. So in the U.S., you can still get the physical share certificates. You can still request them from the broker, but you can't really trade them that easily. You have to, in Canada and I think in EU, you can't do that, or it's very, very difficult. I don't think it's possible in EU or Canada, but you can basically, in the US, you can request the physical share certificate from your broker. They give it to you after 2 to 4 weeks, and then you have it in your name. And then to trade it back, you have to go through the same process in reverse and sign it back to them, and then it takes 2 to 4 weeks to get back on an exchange, and then you can sell it. So you're in this crazy lag. Yeah, you're in this crazy lag buy and sell it. Yeah.
Can I ask another question, or is there somebody else wanting to?
Sure.
Go ahead.
No, sure.
Do you have any insight into companies like PIMCO and so on who are trading in these in sovereign instruments? What kind of valuation processes they go through? I mean, if a government has issued a bond, somebody has to make the interest and capital payments, and it seems to me that we're well past the point of no return with respect to the degree that subsequent generations have to be enslaved in order to make good on the consumption promises to current retirees in North America and Europe. It looks to me from an actuarial perspective like an impossibility. And just maybe to bring it home.
I think,
yeah.
Well, that's where wars might come in, because it's like I think the like you're saying, it's impossible for them to pay these things. Historically, when governments got into these situations, they just didn't, and they entered a default, and usually they need a crisis like a war to sort of to do that within to give everyone give them an out. I mean, so history's filled with these cases of governments kind of massively overspending. They have a lot of times, like I think the city of Mainz in Germany did really well. The economy was booming, but then the government got really greedy. They started taxing more and more, getting crazy with the bureaucracy. They started punishing the inhabitants, the taxes, and then everyone just left. The tax base left. The whole thing didn't work, and then the creditors sacked the city, and the whole thing, they didn't pay the debts. They got collected on. So, I mean, the government's kind of screwing around and making trouble like this happens throughout history. But yeah, I mean, you're right. The chances are they pay it is gets less and less the more crazy they get.
So what kind of people are employed at PIMCO who can put values on those bonds?
I mean, it's just, I guess they're just patting the backs of their customers. I mean, it's not professional. I mean, they're kind of stretching the books a little bit. So
there's that famous Egyptian fellow who ran the whole story for many years and features everywhere in the newspapers and the television and so on. But as far as I can tell, he doesn't know the first thing about valuation.
No, I don't know.
Like Mohammed Ibrahim or something like that.
Yeah, I'll look into that. PIMCO Ibrahim.
Yeah, I mean, it's as far as I know, it's like one of, if not the biggest, then one of the biggest bond fund mutual funds, bond mutual funds in America. Sorry, I had to think because we call them unit trusts.
Okay.
Yeah.
No, look into that. Thanks.
Yeah. It's just, I just struggle to see how the face value of those bonds is at all meaningful.
I mean, that's the irony of all this. The U.S. Treasury bonds and these government bonds are considered the best assets, but the underlying fundamentals are getting crazier and crazier, right? Yeah. So this is kind of what's going on now with this price of gold going up, is that central banks around the world are stop holding U.S. Treasuries as a reserve asset and switching to gold, because as the books get more and more crazy. So I think Elizabeth had a question.
Yes, Elizabeth.
Yes, thank you. I was actually just madly looking for my notes. I actually called the clearinghouse a couple of years ago about this issue and talked to various people. The bottom line was nobody was helpful. Nobody really knew anything. It was extremely frustrating. So my question is, I chose to save in U.S. savings bonds, which is very old-fashioned, and I've been slowly decreasing the amount I owe. These are the I bonds that pay interest, but I still have a chunk there, and it sounds like you would recommend getting completely out of those. That would be my first question.
The U.S. Treasury bond, or what was it?
No, savings bonds, the I bonds, interest. They pay interest. They're totally different. They're not tradable. You own them. I don't know. Do you
have the physical certificate?
No, I turned those in. So they're held in Treasury Direct, which is an online digital place where you redeem them into your bank directly. And they make interest every 6 months. And I've had them for almost 20 years and slowly been getting them out because I was worried about a default. Now I'm even more worried about a default. They were old-fashioned. People used to give $25, under the Christmas tree in a U.S. savings bond, and they used to be certificated. They are now, as far as I know, primarily digital. Anyway, since it is an obligation of the U.S. government and I am worried of default, do you think it's prudent to get rid of them entirely and redeem them all? Or what's the danger of them collapsing? I know Bill Bonner's group holds treasuries. Their investment manager doesn't seem too worried about these savings bonds, but I was wondering your perspective if you're familiar with them.
Yeah, I'd like to, that's the sort of Treasury's portal, right? The Treasury Direct.
Treasury Direct is an online portal where you can go in, see what you own, and redeem it directly into a bank. They are not tradable. I've owned them the whole time. I do not know if they have taken out if they've used them as collateral, like we are talking with the other stuff, with clearinghouse, with stocks. Nobody seems to
Yeah,
know
no,
much about
I'm
savings bonds.
sure. That's like a government. It's like a government custodial system, right?
Yeah, it's all government, straight treasury, and you get your interest. It just sits there, and every 6 months, and whenever you want, you can redeem, $1,000 at a time. But hundreds of thousands over the years.
I'm not.
If you
Yeah, I'm
redeem it.
not sure if they're using it as collateral, but they're saying if you want to use it as collateral, you have to take it out of there.
Yeah, to get your money back. No, it sounds like you're saying turn everything that's tied to the U.S. government into something like gold. I just didn't know.
I just think
if
between
about
now and
savings bonds.
2033, we're just getting into a very chaotic period with wars, with there's a lot of destabilizing events. I mean, for the first time in history, we've seen the Trump's tariff things are creating more instability with U.S. Treasury bonds being held by institutions around the world. I mean, it's just, I think mainly people are in a mode of like just saving your money than making money, because if we get into a big collapse kind of situation, you'd be happy you just had it in gold or something,
Yeah,
So I don't know. I
hard to
mean,
know. Nobody seems to know about savings bonds and how safe they are compared to other investments.
These treasury bonds you're talking about?
No, savings bonds. They're not treasury
The savings bonds.
Well, they are still guaranteed by
Right.
by the U.S. government in their ability to tax their citizens. So my first thought would be that they are unsafe from the perspective of the U.S. government solvency. And if you think
Yeah, I
that,
mean, I'm looking at their paperwork. They're saying that financial intermediaries cannot use those bonds as collateral. But I would ask them very, very pointedly, and just ask to see their paperwork. Are they at all used? Are they at all used as collateral, or yeah?
or are they held with a clearinghouse? Right? That's also possible.
The Treasury Direct is like a U.S. government custodial system.
Yeah.
Okay.
Direct treasury in theory, right? Who knows? But I did not ask
Yeah.
the paper. You can't get a human. You literally can't get a human at the Treasury to answer the phone. I've called.
No,
I don't know.
this isn't the first time I've had someone ask me about this, so I'll look into that so I can answer it more.
Sounds like
pointedly. But yeah, this.
Indonesian stocks, yes, ones that are not part.
No,
of
I'm not
system.
suggesting Indonesian stocks. I'm just saying that I met when I got here, I met one of the Mavericks guys who set up Morgan Stanley's office in Indonesia, and he was telling me how they when you buy a stock here, you set up an account in your name, and then the stock, your broker sets up an account in your name, and the stock purchases happen in your name and then are kept in another brokerage kind of account in your name. So it was like a system like we had before in the US, where you have a clear title to it, where that's not the case in Hong Kong or Singapore or in the West now. So
the reason I was
and
asking,
a lot of times.
Oh, sorry.
Yeah.
Go ahead. No, go ahead.
There you go. That's fine.
No, I was just going to say, the reason I was asking is if you're not comfortable, shifting everything into gold, because obviously you want to stay diversified. My mother and grandparents lived through the time when it was banned to hold gold, right? My mom grew up in Russia. And so that's another concern, everybody shifts over to gold and then they pull the rug out from under us there. That's, you're just finding different places to hold stuff. And I am a small player. I'm not one of the big Mavericks players, just FYI, in terms of assets. But, single mom, got to do what I can to save for the future for my family. So I appreciate you doing this. I read The Great Taking quite a while ago, as well as calling the clearinghouse. And what was my other topic? I think I'm done. Sorry. I can't see if someone else.
Yeah, there's there's
Thank
funny
you.
loopholes in the U.S. tax code. Like if you own this looks like kind of it was written for these oligarchs, because if you own gold abroad as an American, you don't have to report it. And but the requirement is that you have to have it abroad and have the key to where it's kept, and no one else has the key. So I have a friend who's actually speaking at this Swiss conference this weekend, Claudio. He this. He specializes in this. If you want to buy gold in Switzerland, and they'll keep it in it's like a little cigar box, even with a little key on it, and then that'll be in the safe. But that'll qualify for the U.S. code of not having to report it. It's just like there's these weird little loopholes. So if you own gold in Austria or Switzerland or something, and then you had the key to this little box, only you did, or part of a safe or something.
Or get a private safe box in Dubai, and they do the same thing. You own the keys to the private box as well.
Then you're exempt from all
my master of
reporting
disaster mind goes to, what if they prevent us from flying and can't leave the country, and then it's useless. I used to call my mom master of disaster, and so I'm able to go there in my mind as well. So I just try to think of every scenario and try to cover all my bases. That's all I was saying.
Okay, thanks a lot, Elizabeth. James, we have a few more questions to cover, so I'm thinking we go through these questions because the time will be up soon. Steve has a question. If you have an Indonesian broker, the safe custody would only apply to Indonesian securities. Is that right?
Yeah, I mean, I think if you bought securities that were, you could go through an Indonesian broker, but buy securities on a foreign clear, held in Euroclear or DTCC, you'd still be exposed to those intermediaries and what they're doing with them. So yeah, this would just be for Indonesian stocks. What is the other one? Well, the obligor, the U.S. government can itself.
Now, the second question is from Stefano. What would be your solution if you had stocks with a US EU brokerage account, provided you'd still want exposure to these stocks? Just Indonesia, or are there any other alternatives, if you have any?
Well, I think U.S. stocks and bonds, you can request the actual physical share certificates. So just to give you an idea of the magnitudes, there's 89 trillion, I think, of U.S. On the DTCC statements, they say they have $89 trillion of under custodianship. And I saw an article from a few years ago. It said there's about $700 billion of U.S. stocks and bonds that are in non-dematerialized form. So they call it dematerialized when they get rid of the stocks and bonds. So back this was a part of this progressive sort of shifting over the industry to be more and more able to be played with by the industry. So there was a G30. It's kind of like a G20 type organization of all the big states. They passed all these mandates saying we want to dematerialize all the stocks and bonds. So these big pushes to make these things more and more fungible, dematerialized, kept in pooled form. So in the U.S., there's about $700 billion of stocks and bonds that have yet to be dematerialized. I found an article saying, "Oh, we gotta dematerialize this last little bit," So I think you can get a stock or bond and ask for the paper certificate for them. I think an issue you might face is if there's a economic downturn, you want to sell the thing, you're going to have a long period to put it back. You have to take it out of dematerialized form, get the physical share certificate, and then if you want to sell it, you got to put it back, and that'll take you another 2 to 4 weeks. So it's not like a quick sell kind of thing. But you could buy like gold mining stocks or some big kind of dividend sure bet kind of like long-term hold kind of company like that. So a lot of wealthy families in the 20s and 30s who lived through the Depression that had their money in gold mining stocks did fine. They didn't lose their money, and they made a bit through it. So because even though they banned gold, the gold mining companies are still making still making gold, still mining it, and so I guess you could buy stocks that would fare well in a period like that, like gold mining stocks, and then get the physical share certificates and hold those. I mean, that's an option that would insulate you from this risk.
The other option might be to hold just enough, expose yourself just enough that you can afford to lose all if time might come. I guess that's another strategy.
Yeah. But I mean, also, like, if you buy gold, you really just want to get the physical gold and have it in your hand. I wouldn't, and don't get it through paper gold. I once interviewed Gerald Celente, the guy that does the Trends Research magazine, who's always losing his marbles on the interviews. So he's so mad, and he had like $2 million in gold with MF Global. It was paper gold. You know, actually, the MF Global case is another case where they were playing with all their clients' assets and they lost it for them. And that's another thing I have to read through is their bankruptcy filing and see if there's any more leads in there. But like they were also playing with all the client assets. And this poor guy Gerald, who's this big gold bug, you know, who's always telling everyone to buy gold, he lost all his shit in this bankruptcy. It was just, and then I don't know. Then he was really mad and he was screaming even more about that. The poor guy. So that's just a lesson. No, don't buy paper gold, but get the physical gold. I always kind of recommend just if it's just generic ounce bars and things, you know, I mean, that's your cheapest over spot, and just get a lot of them.
Great. Thanks, James. That's been a great discussion. Would you like to tell people more about how they can learn more about your current publication? You're going to discuss in more depth about this, right?
Yeah, so really kind of this Friday, I have it formally available on the site, and it's basically a 10-chapter, kind of 120-page report, and the first 5 really summarize the issue, and the last 5 chapters are really a market rundown. So you can buy the first 5 individually or the whole thing. I mean, it is a bit more geared to like a fund manager or a family office or something like that. They want to know a bit more about the issue, but I'm also available to talk to anyone about this, and I'd also encourage people who are from the U.S. to call your local state representative and tell them you want Article 8 amended. On the greattakingreport.com, I have a little link you can find out your state rep, and I think in the U.S. we really do have a shot at fixing this at the state level. EU is a lot more complicated. And then other parts of the world, you know, we can really not try to obstruct them from getting integrated into this. But really, people need to assert their property rights to their own stocks and bonds, because this is really crazy that we've been so misled about this, and there's just an inherent instability in the system, and basically, it just feels like we're entering into a time where this could be hatched under the cloud of war. You know, that we have these economic bubbles kind of coming home to roost. There's this huge push to a world war. I'm also doing a film now with Martin Armstrong on basically the war's always a racket. So I'm concerned about this war drumming. At the same time, we have this huge repo market with these inherent instabilities, this massive derivatives market, and we don't have clear legal title to our stocks and bonds. So I would really recommend people to kind of just get out of the markets. I mean, when you really read these, look at this closely, you really don't want to be at risk to the financial intermediaries. I mean, everyone should ask them that. Like I just briefly, like Jesus Huerta de Soto, my PhD director, the guy's a billionaire. He owns an insurance company. And I sat down and explained this to him. He's like, I kind of get what you're saying. You know, I don't, he's like, but I feel like I'm protected under the Spanish Constitution. I said, like, no, sir, it flows up to Belgium, and they changed the Belgian constitution. And really, your stocks don't reside in Spain. They're really up in Euroclear up there. And he's just kind of not wanting to kind of see it, but I mean, within the next year, he'll have to. But then I went to his son and I was like, here, read my report. You really should be nervous about the one that's kind of taking on the business. And then by the next day, he was like, his hands were kind of shaking. And the guy was like, really kind of, I said, just ask the bankers, am I at risk at the bank? Am I at risk of loss that the financial intermediaries go bankrupt, or am I exposed to their risk? And he's, so people don't really want to talk about it. They don't want to know about it. It's like it's really uncomfortable. So that's why I kind of shifted from a monthly report just to doing a one-time thing, because really I don't think people want to hear about this that much. There's more of a market to tell people that you can buy this and make money than warning them things that they face a loss. But this I think is this really big elephant in the room. Kind of David got this going with his book, but now I'm taking it further, and other people are taking it further, and talking about this and getting this, hopefully getting this changed and bringing it to enough people's attention before we really face a calamity here.
So it's really for people who really want to dig deeper and understand the mechanics behind how this is possible, right? Primarily.
Yeah, if you're in charge of a lot of money and you want to understand the legalese of this and what's the global marketplace for this, it's more for like a fund manager or like a family office. But I am available just to talk to you about it for an hour or two. So you can reach me at info at the Great Taking Report, and feel free to email me there, and I'd be happy to talk to you about it. So
great. And I believe Mavericks members get a nice discount. So thank you very much for doing this, James.
On there. Yeah. Okay.
All right. Thank you very much,
Thanks
James. This was great. Looking forward to meet you in Locarno soon.
Yeah, great. Thank you guys.
Bye.
Appreciate it. Yeah, if anyone has any more questions, feel free to email me, and okay. Thank you.
Absolutely. Bye.